Are you tired of watching your retirement portfolio bounce around like a yo-yo every time the market sneezes? Well, imagine building a portfolio where your income never stops flowing, no matter what Mr. Market does. In today's video, I'm going to show you 3 high-yielding investments, each yielding between 8 and 11% that can provide reliable, stress-free retirement income. These are not gimmicks or flash-in-the-pan ideas. These are blue-chip, battle-tested income machines. So if you want to get more content like this in future videos as well, please make sure to smash that like button, subscribe to the channel for weekly videos on dividend investing, and learn how to achieve financial freedom in a better and more sustainable way, as well as build a retirement you don't have to stress about. Okay, so why invest in dividends in the first place for retirement? Well, again, you have volatility that constantly hits the market. This past 2 months have been a great example of that, with the Liberation Day tariffs causing a market flash crash and then a quick recovery. You don't know what the market's going to do the next day, the next week, the next month, or even the next year. And so if you're depending on the market to give you a good price for your shares to sell over time, to fund your living expenses, you're at the market's mercy. Whereas if you're depending on dividends alone to meet your living expenses, it's a much less scary proposition, especially if you're diversified and you pick the right dividend stocks. Those keep flowing in from most companies for decades, in fact, growing over those decades, rather than gyrating up and down. So you can rest much easier knowing that your living expenses are going to be covered if you take that approach. And you can just kick back, relax, and enjoy life instead of constantly looking at the market to see what's going on with your portfolio and really how much your retirement income changes from day to day and week to week. Okay, but that said, just because it pays a dividend doesn't mean it's automatically a good investment. And so there's a wrong way to do it. I've discussed this in other recent videos, but I think the classic example here that's recent is NextEra Energy Partners. Paid a high yield of over 20% at one point, seemed to be fully covered by cash flow. Management was even growing the payout, had a durable defensive business model underpinning it. But at the end of the day, it proved to be a landmine because the balance sheet was way over leveraged. And so the company had to eliminate the dividend to start paying off debt and equity obligations. And so you need to be very careful, not just look at the durable and defensiveness of the business model, although that's extremely important. Not only look at the dividend growth track record, although that's extremely important. Not even look at the cash flow coverage of the dividend, though that's extremely important. You also need to look at the balance sheet strength to ensure that the dividend is on a sustainable path, that they won't have to choose between the safety of the balance sheet and the safety of the dividend, that they both can work together moving forward. And so in today's video, I'm going to discuss 3 opportunities that I think should be able to pass all these tests. First one is the Gladstone Land Preferred, and it yields well over 7% right now, and it has a lot going for it. First of all, Gladstone Land is a farmland REIT. It's well diversified across the United States, owns high quality farmland properties, and it's professionally managed. And so you get that diversification. Land, especially farmland, has proven to be one of the best investments over the long term on a risk-adjusted basis. Very low volatility in the underlying value of the properties themselves. They've proven to be great inflation hedges because the value of property and its produce goes up over time with inflation. It's very recession resistant because you need to eat food regardless what's going on in the world. And even now, especially with the thawing of trade tensions between U.S. and China recently, as well as other countries, prospects for U.S. exports of agricultural products are rising, makes land that much more attractive. And what about these preferreds in particular attractive? Well, they pay out monthly distributions. So again, for a retiree living month to month, that's nice to get that income every month. It has a fixed rate cumulative preferred, which means that even if management temporarily suspends the payout, they have to make up for it in the future before the common shareholders get a single penny. And given that insiders own a lot of the common stock, they are highly incentivized to make the preferreds whole. Again, also that fixed rate means if interest rates rise or fall, your payout doesn't change. You get that nice stable payout. Now, it's also trading at about a 20% discount to its par value. So if management does redeem it at par, you get that nice upside, that capital appreciation, which we're going to complain about that, makes it a pretty good investment. And additionally, today management is buying back stock of this preferred stock in the open market, indicating they think it's selling at a compelling value as well. So that's a strong indicator that it's a good time to buy it. It also has over 2.5 times asset coverage of the value of the preferred, which means that if the company was completely liquidated today, paid off all of its debt, it would still have 2.5 times the outstanding value of the preferreds in property value, assuming they got market values. That gives a nice big buffer to the intrinsic value of your investment. And they also cover the dividend easily with underlying cash flows. And so again, even if the REIT hits hard times, farmland has some hard times, it's still very likely that your preferred dividend is going to be paid to you. Again, this makes it like a bond-like security, especially when you consider, again, the stability of the underlying asset. Now, sure, it's not necessarily going to blow you, out of the water with total returns unless you immediately get a redemption from management. But this is not one that you buy to maximize total returns. This is one you get just to get that stable payout in retirement. good income that you can count on through thick and thin. And I think, again, it's going to be a pretty decent yield. And again, if you only have to live off of 5%, you can reinvest the other roughly 2.5%. Or if you want to live off of 6%, you can reinvest the 1.5% extra to just increase your income over time to keep up with inflation. That's a suggestion I have. Second investment that could be, pretty good right now is the Kayne Anderson BDC. Now, it's a business development company. These invest in middle market loans, which can be somewhat risky. But the good news with KBDC is that 98% of its investments are in first lien senior secured loans. So again, senior in the capital stack, that should lead to fewer non-accruals and defaults, lower losses. So again, a more stable defensive income stream, especially since it's diversified. Has a very low non-accrual rate, only 1.3% as of this video. Again, it reflects well on the underwriting ability of the manager. Has low leverage, very low leverage, which is 0.72 times debt to equity, which means that they have a lot of capacity to increase their net investment income by adding leverage to the balance sheet, which should in turn enable them to support the dividend even if short-term interest rates decline due to Fed Reserve rate cuts or non-accruals rise due to a weakening economy. So there's that built-in margin of safety. They also have no major debt maturities until 2027, which again hedges them nicely against headwind from refinancing risk. On top of all that, they have pretty good dividend coverage. As of the last quarter they reported, which was the end of 2024, 1.2 times. Now I expect that dividend coverage to probably have declined somewhat this past quarter because of changes in base rates due to the Fed rate cuts late last year. But again, they have capacity on the balance sheet where they probably added some additional leverage this quarter, which should help offset at least some of that to give them higher net investment income to help keep that dividend well covered. And so here you're getting a double-digit yield, around 10% yield with all those strengths. I think that's a pretty compelling opportunity. Again, for income-focused investors especially, and still a pretty decent total return too. Okay, the third opportunity was like the one I like the most of these three, and that's because it combines total return potential with high income in a major way. It's Energy Transfer. Now, it issues a K-1 tax form. The other two do not. So keep that in mind. K-1s aren't for everyone, but for those who don't mind a K-1, you get tax-deferred distributions. You get a yield of well over 7%. In fact, it's somewhat close to 8%. It's covered about 2 times with distributable cash flow. So again, very sustainable, especially because 90% of the underlying cash flows are resistant to commodity price volatility, secured by long-term contracts, very safe. Also has a BBB credit rating, which indicates it has a strong balance sheet. Its leverage ratio is at the low end of its leverage target ratio. So again, strong position there. They recently got rid of a lot of their preferreds to further simplify and strengthen the capital stack. And again, it's one of the largest, most diversified midstream infrastructure companies out there. So you have a lot of diversification and relative safety because of that, the size and the diversification there. And again, they're targeting 3 to 5% annualized distribution per unit growth, probably on the high end of that. So again, inflation beating, combining with that 7 to 8% yield, you get nice double-digit annualized total return. I think deserves some capital appreciation as well to get to the mid-teens annualized total return. And that really stable, dependable income that's going to grow at a rate that meets or beats inflation over the long term. So here you have it, 3 really attractive, dependable, high-yield opportunities and farmland preferred stocks. You have a middle market lender and a BDC, KBDC, that has fairly low leverage relative to a lot of its peers, should be able to sustain its dividend for the foreseeable future. And then you have Energy Transfer, which is a large, diversified midstream company that combines a very high yield with inflation-beating distribution growth. So I think when you put all these together, you get the foundations of the beginning of a really attractive income portfolio. So if you like this content, again, please give this video a like. Let me know in the comments below which of these 3 picks you like the most, or if there's another one you like even more. And subscribe to get more of this content in the future. Thank you very much. See you next time.